First Friday of the month, you know what that means. Cake Day here at the Motley Fool. And the jobs report thing, too. That too. Investor Beat starts now. Thanks for watching. I'm Chris Hill, joined in studio by James Early. You're not a cake guy.
I'm not a
You eat
cake
very healthy. You're not big on the desserts.
I would not come. This is the closest to a cake I've been in a long time.
All right, we'll keep it over there for now. Let's get to the jobs report, though. Monthly numbers out for March. 192,000 jobs added. Unemployment rate unchanged at 6.7%. What stood out to you in this report?
You know, there are two narratives, Chris. The first is that we're treading water. The Fed is probably not going to be motivated enough by this to take any kind of drastic action, so that's good. But a lot of these jobs were temporary jobs, which is not so good. Then furthermore, if you get kind of the bigger picture issue, we got a lot of young unemployed people, got a lot of outsourcing that's going on globally, and we've got a lot of older people who are 65, 70 years old, and they've got like $6 saved for retirement. So these people are going to stay in the workforce longer. So structurally, in the near term, yeah, this is okay. But structurally, I think we've got a different workforce now than we did, say, 10 years ago.
In terms of the market, though, some people looking at this and saying, hey, this is maybe the ideal scenario in terms of a jobs report because it's not so robust that the Fed is going to step in and say, oh, we're going to taper much more quickly.
I think that's true in the near term, Chris. I still don't think it solves the long-term issues here.
All right, let's get to the hot IPO of the day, of the week probably, and that's Grubhub, the online food delivery company. They went public today, shares up more than 35%. I thought we had a little bit of sanity return to the market last week when we had an IPO that didn't explode. But I don't know, maybe this is warranted?
These guys are raising less than $200 million. It's not a very big offering. It's surprising. The idea to me, it's been around for a long time, right? 15, 20 years at least, nothing earth-shaking. I don't see the competitive advantage. Frankly, a lot of these frisky little internet businesses these days are not so hot, so I'm surprised. Maybe they just priced it low. I think the fizz is more than the substance here.
We've seen a decent number of IPOs, certainly over the last year and a half, but even just so far in this calendar year. And what you keep hearing over and over is like, well, it's the best possible time to go public because they're able to raise so much money. Are we going to see that slow down anytime soon, you think?
You know, nobody knows. People see the stock of a company like Grubhub, and I don't mean to bash them. Maybe it's a good company. I mean, I think it's a little cheesy, but they see these guys making money, then they're going to keep doing it. And it works for both ways. The market is all psychology based, so as long as it goes, it'll go. All
right, let's get to the big investing debate of the week, and that started last Sunday with Michael Lewis, the best-selling author, his new book Flash Boys, about high-frequency trading, and it's really ignited this debate where on the one hand you have Charles Schwab, not just the company but the man himself, putting out a statement saying, yes, this is a huge problem for investors, and at the other end of the spectrum we have Jack Bogle, the father of the index fund, saying high-frequency trading is good for small investors.
Of all people, high-frequency trading is kind of like your horoscope, Chris. You can read into it whatever you want. I mean, there are good points like adding liquidity, and there are bad points. Like, it's sort of unfair. It causes volatility. So yeah, I mean, it's ironic because index funds complain about high-frequency trading because people jump in front of their rebalancing, right? Schwab obviously doesn't like high-frequency trading, but these guys make money on the spread probably in much greater quantities. I think I read a Purdue study showing that the profit in 2012 was only like $1.2 billion from high-frequency trading, which is not very much. In other words, there's a lot of talk, but not a lot of profit.
Certainly a lot lower than in 2009, which is when a lot of the research in the book ends.
Correct, yeah, and supposedly the profit then was about $5 billion. So that's been cut substantially. Mostly these guys are taking money from each other's pockets. It's skimming a little bit off a transaction cost, but overall it's not as bad as people think.
All right, that's going to do it for this week's action. Let's look ahead to next week. Give me a stock that I can put on my watch list.
Veolia, Chris. We're seeing a resurgence of the kind of the dull, boring stocks, which I love because they're exciting to me. You see the LinkedIn's and the Teslas. The
Grubhubs.
The Grubhubs, yeah. Those are struggling lately, but the boring kind of utilities like Veolia, which is a French water, sewage kind of municipal services company. Nothing very exciting about it, but its stock has gone up about 70-something% in the past, say, 9 months. It was a loser for a long time, but these guys are starting to see their day, and I'm happy.
So you think, despite the run-up it's had in the last 12 months, still got some room?
More to run. It's got about a 4% yield, too, which kind of pays you to wait.
Music to your ears. Absolutely. All right, for James Early, I'm Chris Hill. Thanks for watching. We'll see you next week.